Welcome, everybody, to Secret Sauce, the show where we unpack business tips, life hacks, and advice from industry leaders. I'm Karly, iacono. Today, I have a CBRE coworker, Jon Faulkenberg, who is the Executive Vice President of our Debt and Structured Finance Group. Jon, we are so anxious to speak with you today. Thanks for joining us. How are you?
Good. How are you?
Excellent. We are out there doing deals and keeping it positive despite market conditions. So I'm sure you are doing the same.
Trying.
Yeah, fighting the good fight, right? That's what I tell everybody every day. Fighting the good fight. That's all we can do. So you are a really important piece of the deal puzzle right now. Everybody is asking us what is happening in the capital markets. What does debt look like? What are the financing options? I think basically every single conversation I have starts with that instead of ends with financing. So really happy you could come join us and share your perspective. So why don't we start with just a quick background on you and the types of deals that you're working on, because I know your breadth of experience is pretty wide.
Yeah, thanks. Thanks for having me. So I came to CBRE in 2017. Prior to that, I'd started a commercial mortgage banking company in 2008, right around a very uncertain time, like we're kind of facing today, but probably a little worse in 08. But that company was called Capstone Financial. And as we came to CBRE, we widened our financing types, but we had done all asset types prior. We did multifamily, industrial, hospitality, but our main focus, triple net financing. We've done anywhere from a $250,000 loan on I think it was a Pizza Hut that was just a little franchisee in the middle of nowhere, up to a $180 million portfolio of Heartland dental offices. It's been a wide range and across the country you can't go to the same lender for a $250,000 loan to a $180 million loan. So we've got a vast range of, anywhere from CMBS, life insurance, banks, balance sheet lenders. We have to be able to stay competitive and know what's going to be the best service to our client at the time, whether it be a large institution, 1031 buyer, or just investor looking to capitalize more on their money today.
So it's great to know that you can finance deals sort of a very wide range of price points. And it sounds like asset types with a great depth of experience in net lease. It's a really good framework for today's discussion. What are you seeing overall in the market? Why don't we start with what types of lenders are most active? And that might be different, of course, for different types of deals, but give me an idea of who you're seeing putting money out with the most frequency right now.
I would say even for all asset types, we're seeing banks.
Okay.
Regional banks. That's where we're seeing in our wholesale banks that we work with they have like programs for triple net deals for like Walgreens. So we're working with them quite a bit. They're the most active. I would say it is probably, I'd say 65 to 70% of our business right now. And the next being either, I would say, life insurance company or our balance sheet lenders that are not necessarily just banks. They're just funds that lend. I'd say, and I guess that segues into what are we seeing mostly of type of either be refinance, construction, or acquisitions. I'd say refinances are 60 to 70% of our opportunities right now. I'd say construction and acquisitions are about the same, 15 to 20% of what we're seeing in opportunities. Refinances are big just because either somebody they got a loan coming due, so they have to do something, and they don't want to sell because they feel like they're selling at the worst time, even though that may not be. I think they're just comparing it from
2021 or even a year ago, 2 years ago. Yeah.
Yeah. So probably the cap rates historically are still really great, but maybe they just bought it in those years. So they want to refinance even though the interest rates are high, or they have floating rate debt that they need to mitigate some interest rate risk, or they don't want to pay expensive rate caps that are coming due. So that's a lot of the situation we're seeing with refinances right now. Surprisingly, construction still is pretty busy for us, which I thought that would slow down. But I mean, a lot of developers are out there still doing deals, wanting to do deals because they're optimistic that interest rates are going to come down in the next 2 years. I would say, well, most of them would like to say by year end, but yeah, I think it's not going to come down significantly for 2 years. That's my opinion. And then acquisitions, the opportunities we're seeing with that are mainly 1031 buyers that are basically feeling like they have to do something, and they're not as return driven. Of course, they want the best interest rate, but they deferring taxes is their number one goal.
Let's go through each of these, because I think it's interesting because there's such different motivations and reasons for trying to tap the debt market right now in each of these three buckets. So on the refinance, were these short-term loans put in place 5 years ago, 2 years ago? Were they the construction loans that are now going to perm? Like, who's refinancing now? Or is this just 15-year debt that happens to be coming due? What are you seeing be the primary driver in terms of why now?
I think it's all the above of what you said, but I think one of the bigger reasons is because there was a lot of floating rate debt that was originated in the past few years, and there's a very large amount coming due. And they could have took the best leverage they could at the time with the lowest interest rates and the lowest cap rates we ever saw. So they're in situations where they may not be able to refinance the full amount. We got to come up with something creative to be able to help them out. Either it be a senior note with a preferred or equity piece or mezzanine piece behind it, or they got to come in and write a check to refinance. Or I recommend you to go out and sell it for them, because that's the best thing.
Usually the right answer is calling me. I mean, if we're being honest here, just kidding.
Yeah, but it really is. So, some situations,
some cases for sure.
Yeah, they're going to lose money if they don't.
Exactly.
Or more money.
Are you seeing the refinance capital stack get more creative? Is it, like you just mentioned, a few like a mezz piece, or like are the way the overall stack is structured, is that any different than you saw a few years ago, or is it really the same, just at higher rates?
There is the senior notes the senior lending, the first mortgages have become more conservative because they've had to with interest rates, but then their underwriting has also tightened some. So you do see other groups that are coming out a lot more like preferred equity to be able to offer a higher interest rate type solution for that second piece to cover that gap if they can't pay that full amount off on a refinance because they over levered before on either coming out of their construction loan or just on a refinance. So yeah, we're seeing more aggressive, but in general, I would say the lending is more conservative. Just in general, our deals getting done. Yeah, we're getting things done, but it's just there's not as many options as there was before.
Can you make this a little more tangible for our listeners and give us just some recent deals you've looked at? Obviously, you don't have to share addresses, but an idea of the types of terms that you're seeing from lenders, either on acquisition or on a refi. We'll touch on construction next. I feel like that's a slightly different animal.
Yeah, so I would say it's relevant to maybe what you sell. Is I've 2 Walgreens that came across my desk. The cap rates, actually it was a Walgreens and a Bridgestone. And the cap rates are still low. It was, I believe, 5 to 5.25 range. And we went to one of the lenders that we've used over the years, have done a lot of business with, and we're able to offer a 10-year fixed loan, and it was a 180 spread over the 10-year treasury. So today that would be about a 5.75 to 5.8 rate. Maybe we could get it like a year of interest only, but we're going to be at leverage. We're going to be constrained at around 57% loan to value.
Right.
So if you look at that, you look at a 5.25 on a cap rate, and you're looking at 57% leverage, and you're borrowing at 5.75 to 6%. It's just difficult to like say, hey, this is a good return on my money. But it was a 1031 buyer, so they're going to do it.
Right. To avoid the capital gains.
Before, when you were 4% on your interest rate, that deal made a lot of sense.
Right.
But now, it's just completely different.
And are these recourse or non-recourse, or it depends on the deal sponsor?
That one was partial recourse.
Okay.
Yeah. And it does depend. I mean, we can get complete non-recourse, but this was the best pricing we could get, and this incorporated partial recourse on the deal.
And this is a fixed rate term for how long?
10 years.
Okay.
Yeah. It's a good product, but you have to have that type of credit quality to be able to offer that. If it was, a franchisee with 25 operators and or 25 units, we couldn't offer that same type of product. We're going to go to a local regional bank, shop it to 30 or 40 banks, and we'll probably get 5-year money, 25-year amortization with the same type of leverage at a rate around 6%, full recourse.
Right. And to our listeners who are maybe new investors, we're talking about the credit of the tenant. So Walgreens has investment grade credit, it's a corporate guarantee. So different financing terms are offered than, let's say, a fast food restaurant that's a franchisee, like Jon just mentioned, with maybe 25 units, but no real credit behind the guarantee on the lease. So of course, your lease term, your location, all the things we talk about every day matter, but the credit of the tenant affects the types of lending programs that you'll be able to get. And those were the different examples that he was just giving. Very interesting. Thanks for kind of breaking down where we are right now in the market in those actual terms. That's, I think, extremely insightful. What are you seeing on the construction side? So you said it's active. I've seen construction pull back a lot in the last few years. So I'm excited to hear that it's active, because I love new construction deals. There's obviously tremendous demand for them in the market. What sort of construction loans are you putting out? What types of deals are you seeing being really active? And what do those terms look like broadly?
So I would say I am more active because I think developers are seeing less options of what you just mentioned. They're not be able to go to their 5 banks and get 5 offers. They might get 1 offer or 2 offers now from their banks, and they're much lower leverage. So clients that I don't normally hear from are coming to me asking about construction and what type of terms we can offer. And so it's actually it's become a bigger part of our business when before it wasn't. And a lot of times I didn't want to take it on because of the amount of work, and probably wouldn't get it, and their current lender would probably just match the terms. Right. But a lot of the construction that I'm doing, it's in a little bit different space. It's triple net on some with industrial, but multifamily. We're seeing leverage points on deals, 65 to 70% loan to cost, but some smaller credit unions that'll participate deals will go a little higher in leverage. And that's important to a lot of developers right now, because they're not used to putting in, weren't used to putting in as much equity as that is required now. They were, putting in 20, 25%. Now, a lot of majority of banks are requiring 35, 40% upfront. But the larger developers that are doing deals that are 50 million and above, they're even having difficulty with the large banks like the Banks of America and the, even large regionals, super regionals like Fifth Thirds. Their leverage is different than what they were offering before. And there's just not a lot of groups you can go to that can just finance these very large deals. So what's becoming an option and what we're doing a lot for clients now is we're going to life companies that offer construction programs. They're not necessarily going to be much different on leverage, but they're offering
more proceeds,
different types of products, like fixed rate products up front, and they can take on the whole deal because their capacity is huge. So actually, we've got quite a few of those in the works.
Very nice. Very nice. Congrats.
Yeah, well, we have to execute and get them closed. So the reps are high, but we have to close them.
You got to celebrate each stage of the deal process.
Yes.
So good job getting them these big deals this far. Before we move on, can you touch on CMBS and what you're seeing? I don't know how active you are with those types of deals, but what are you seeing in the CMBS market?
So CMBS, they are lending. I mean, we work with a few of the largest ones that I know that I've done business with in the past. And they are lending, but their spreads are very high. Okay. So you're looking at, let's say it's a multi-tenant, unanchored retail for $15 million. I don't, just take an example. You're going to be looking at let's say it's a 6.5 cap to 6.75 cap. You're going to be looking at a leverage point of 60 to 65% and about a 280 to 300 spread over the 10-year treasury.
It's wide.
So yeah, you're going to be upper sixes. You maybe will get some interest only for a few years, but the positives, they're lending, right?
Right. They're not totally frozen. Mm-hmm.
Yeah, and it's non-recourse debt. It's 10-year fixed. Right. It makes sense in certain situations. It's definitely down though. I mean, we did a lot more of it the past couple of years than I'm taking certain deals as, hey, I've got a refi on this, Walgreens before that would have been competitive. It's not.
Well, that used to be the draw, right? Their terms used to be the most competitive. So you put up with all the restrictions and all the hassle of getting the deal done to get the rate and the terms. But it seems like that's the opposite now.
Yeah, I think just overall, it's a volatile market. And I think uncertainty makes investors, this, just want to sit, basically be paralyzed, like just sit on the side. They don't want to make a mistake. I think if we can just get to a point where we know rates are going to be 5.75 to 6.25, not know, but feel comfortable. Hey, 3 to 4 months out, I just think that activity will just spur again. It'll go more than what I'm seeing right now on the acquisition side. Now you may be seeing a lot more on the acquisition side than I am, but it's become less than I'm used to, especially on triple net side.
Right. People crave stability and predictability, and there is none of that right now. So I agree. I think we'll all feel good when we have an idea where interest rates are going to settle, whatever that number might be. We're just not quite there yet.
No, we've got March 22nd. We're probably going to get another 50 basis point rate hike. I'm hoping that the treasuries will at that time already built in the spreads. Hopefully the 10-year treasury stays around 4 or a little bit under. But don't ask me what I think is going to happen. I hope this is one of the last rate hikes we see this year.
I know, you and me both. And I'm even holding out a little bit of hope that it's only 25 basis points, but I think you might be right. All right, Jon, this has been great. Thank you for sharing the ins and outs of the financing market and where we are now. We really appreciate your time and your insights. So thanks again for joining us.
Thank you, Karly. Appreciate it.
And to everyone listening, that was Secret Sauce. We're so glad to have you as a listener, and we hope to see you again very soon. Have a great day, everyone.